There was so much that happened this week, but when you really distill it down to just a few things, it really boils down to investor sentiment and really what investors generally expect out of this market and out of this economy here. How do you view investor sentiment right now?
Romaine, first, happy Friday evening. I think investors might be getting a little bit ahead of themselves and where the economy can grow to this early on in a recovery. We had a very sharp initial recovery. I call it phase one of the reopening earlier in the spring. We're now seeing some headwinds to that recovery with the supply shortages, the higher shipping costs, the lack of labor. And what we expect to happen is a phase two reopening to develop after Labor Day as kids are back in school, as those extra unemployment benefits run out. And so I think what we're seeing is growth is coming in a little bit lower than expected in terms of GDP growth. But what that tells us is that it's going to take longer for the full recovery to take place as those shortages ease and labor comes back. And that means that growth will run ahead of long-term trends for longer. And that means if you're in the market, as we hope, like our clients are in the market for longer, you don't care so much about this week or this month or this quarter. What you care about what investors can expect to see in terms of years of investing. And with the growth outlook looking above trend for not just a quarter or a month, but for several quarters to come, it's actually a pretty good investing environment if you select your stocks carefully.
All right, well, let's talk about the economic environment, backing up that investment environment, Aneta. When we look at some of the most recent data, yes, GDP growth came in a little bit less than what folks were expecting, but we saw some pretty strong consumer spending numbers. And I'm wondering, how do you sort of sort all this out to get a better picture of what that long-term sustainable growth rate is?
Yeah, I completely agree with Joanne. It's been a disappointing first half of the year for sure. But when you look sort of under the hood of the GDP report, final demand very strong, not just consumption, but business investment as well was better than expected. And the weakness really came from areas where it's unlikely to be sustained. We had another big inventory drawdown that will eventually be reversed. Trade was also a drag, and as was housing and government spending. Housing is one area where maybe the weakness is fundamentally driven, but all these other areas of weakness are likely to be reversed. So, I mean, the inventory cycle in particular is something that I think will be very additive to growth over the next year. I mean, inventory levels in this economy are as low as we have ever seen. So while there's a lot of concern about demand slowing at some point, right, as kind of the fiscal stimulus impact fades into the background, but there's so much catching up on the production side of this economy that has to happen that we'll probably see over the next 12 to 18 months. I think that will support well above trend growth, for the foreseeable future.
And that's a great point, Aneta. But when we talk about the Fed and what it's looking at, obviously they're paying attention to that. I assume they have to be paying close attention, too, to the labor market. We get a big labor market report next week with that monthly jobs figure a week from today here. Is the jobs recovery, is that keeping pace here with what we're seeing with regards to consumer spending and some of the other elements of the economy?
No, it clearly hasn't been. It has been very disappointing. And we've seen as a result very, very strong productivity growth. The question is, can companies sustain that, right? And sort of seems like something has to give at some point. Either the labor market really has to start catching up, or this is going to start weighing on growth, particularly in the service sector, which is obviously very labor intensive. I do think there are reasons to believe and sort of be constructive on employment growth picking up. I think as early as July, which obviously we're going to get next Friday, we're actually looking for a 1.2 million increase in payrolls. And that's for two reasons. One, I do think that the expiration of unemployment benefits in those 25 states will help to ease those supply concerns or the supply constraints in the labor market on margin. I'm not saying they're going away completely anytime soon, but I think on margin that helps. And we certainly heard some anecdotes to that extent. But also, you really have to, when supply is constrained, you have to think about the data in non-seasonally adjusted terms. So employment, actually non-seasonally adjusted terms, has increased by an average of 1.1 million since February, very consistently. And seasonal adjustments have knocked off on average 500,000 from that, right, resulting in sort of subpar growth. Well, in July, that actually swings the other way because you typically get a big seasonal slowdowns And so seasonal factors will be adding over 1 million.
Right.
And I think there are reasons to believe that we're not going to get that seasonal slowdown in a lot of industries where you have a lot of pent up demand, leisure and hospitality,
Yeah.
personal
Yeah.
services, even construction. And so
Yeah.
it makes pretty easy to actually
Yeah.
get 1 million print on this payroll
Yeah,
report.
I want to bring Joanne back into this conversation, Joanne, because I'm curious, are you buying into the growth story, not only for the economy, but the idea that some of these industries will continue to show a little bit of resiliency here, even as we maybe get some choppy data along the way?
Yeah, I mean, I think what we're seeing from the company side a fair bit of resiliency. Obviously, there's a lot of holdups because of those shortages, and they're not being able to produce and generate the sales as much as they'd like. But in terms of the reopening trade, right, that's been weak since mid-March, and that really was, it seems, coincident with this spike in the Delta variant. We saw the 10-year yield go down at the same time, and so I think there's a bit of tentativeness. I agree. I think we're going to see that pickup in jobs with the latest number coming up. And I do think that the sectors that are feeding into the ongoing consumer spending recovery, there's an awful lot of savings out there. Plus, let's not underestimate the cash that's flowing into bank accounts from the child tax credit and the ongoing demand just to get back out there. We saw services spending really improve now for 3 months straight, even as goods sales were a little bit light. But overall, it just seems like there's an awful lot of pent up demand. We're also seeing, for example, that housing shortage continue to feed into a good
Hmm.
potential run of profits for not just the home builders, but the furniture suppliers, the appliance suppliers, and all of this has just been held up by shortages. And so I think there's just an awful long runway ahead of these companies. And that, is not only going to buoy their profits and earnings, companies like Lennar and Williams
Yeah.
Sonoma, the back to school trade helping Target, for example. There's just a lot of money on the sidelines in consumer bank accounts.